Ramakrishnan on the show now. Mr. Ramakrishnan, good morning. Thanks a lot for joining us. This is Pavitra. I want to begin by asking you about the net interest margins. We've seen that it has come in at a 6-quarter high. It's at around 2.8%. Can you tell us how this is likely to trend going forward? Do you see this kind of improvement likely to continue?
So this growth we have actually particularly seen in once we started growing our assets from Q3 onwards. As you know, the first quarter of the just concluded year we had COVID too, and that was a time when we were also doing a lot of changes in the way the bank is structured. So Q3 onwards, we have started seeing the growth in the asset book, and as of Q4 end, we have grown over the previous year by around 4-5%. And also in terms of the composition of the asset which we have grown, we have also looked at growing products like personal loan, credit card, where the quality of the portfolio as of now has been impeccable. So with the good rates available there, I think overall we are seeing a good traction there. Even with respect to business loans, etc., there is a continuous effort to pick good quality cases at reasonable rates so that we are not bogged with delinquency provisioning in future years. So the new book which we have built, we are seeing very, very low NPA levels, because of which I think the margin, overall we are seeing a good traction in terms of the profitability.
Your slippage ratio has been consistently coming down. It was earlier more than 2,000 crore. Then a couple of quarters back, it was 800. Now you're trending at 350 crore. Two-part question. One, if you could tell us, where is it that you've seen improvement in terms of the pain? Where is it that the pain still persists? And secondly, what would be your guidance on slippage?
Yeah, the impact on slippages coming down primarily is due to the fact that tremendous efforts have gone in recovery and upgrade of the portfolio. Just to give you some numbers, for the year before last, for the full year, we have done an upgrade and recovery of close to 600 crores. For the year just concluded, we have done a recovery and upgrade to the tune of 1,500 crores. So there has been a 250% growth in the way we have gone about recovery and upgrade. So clearly, in terms of bringing back the cases from various SMA levels or NPA back into lower buckets, etc., that there has been a considerable effort, and so that has resulted in slippages overall coming down. Secondly, I think the entire new book which you started building, which is close to about 20,000 crores, which is almost 30-40% of my entire book. There, as I said earlier, the GNPA is just about 0.01%. So it's an impeccable quality of the book. And this is something which I've been sharing even in my past conversations, that I am very clear that during the COVID period, what we want to do is to go and pick good assets. We are not in between quality and growth. We have always gone in for quality cases so that we're able to build a very robust portfolio. And this is expected to stabilize, this is expected to hold on for years to come. So that's the overall. So in terms of the percentage, guidance which I would want to say, overall we are looking at a slippage of close to 2 to 2.25%, and credit cost we expect it to be around 1.75 to 2%.
Mr. Ramakrishnan, good morning, sir. In terms of your Kerala loan book, there has been a slip both YOY and QOQ, although, I wouldn't say it's very big right now, but is it a one-off, or is the market saturated, or are you looking at concentrating elsewhere?
See, actually, as far as the approach towards sourcing any transaction, it's a quality which we are looking for. Whether it is from Kerala or from anywhere else, we are going for good quality transactions. But if you look at Kerala, what has specifically happened to the state over the last few years is that we had 2 consecutive years of flood, plus we had this COVID hitting for 2 consecutive years. And as you know, Kerala as a market is full of business loans, small businesses, and very few corporates, I must say, in comparison to the other states. Therefore, the focus has been on building SME over the last 4 to 5 years. When we had a concentration risk in the corporate portfolio, the bank had gone in for diversifying risk by focusing on SMEs and retail, etc. And this is precisely the segment which got hit with this floods and with the COVID, etc. So overall, if you look at the numbers of number of cases as well as in terms of quantum of cases which is getting restructured due to the business model impact due to various calamities, Kerala definitely has bore the brunt of it. Therefore, we are we are definitely looking at growing all the markets wherever there are good deals available. So it's it's nothing too specific to say that we are moving away from Kerala or we are going towards other markets or anything like that. Wherever good transactions are available, wherever good deals are available, if the business model is viable, we are going for it. I mean, as a geographical distribution, we are obviously very well entrenched in Kerala. Out of my 18 regions, 9 regions are based out of Kerala. So it makes a lot of logical sense for me to really focus and build a good quality book in Kerala. We are clearly looking for such transactions, and I'm sure it's just a one-off thing, and I'm sure we will be seeing traction happening across the country, including Kerala.
Okay, do you have some guidance on what you would expect out of Kerala? We've seen a little bit of a decline, around 1.4% in terms of a decline in Kerala. Can you tell us what you expect going forward?
I wouldn't really speculate on percentage specific to one particular market. As I said, I am focusing on good quality transactions everywhere. If it's from Kerala, we will definitely grow Kerala.
Just one quick question, sir. Your credit cost was just 0.8%, right, in Q4?
Yes.
So you're guiding for credit costs of 1.75% for the next year.
See, Q4, you should remember that Q4, you are comparing with the full year. So if you look at my previous quarters, etc., it's been high.
Yes.
So see, the way I look at it is even for any bank, for that matter, even large banks or large public sector or private sector banks, for a certain portfolio size, there is an expected slippage, which is we have seen consistently across all banks. So we are expecting certain amount of slippages happening from any portfolio. Plus, we look at specifically the restructured portfolio, which we have got almost 2,400 crores, which is lying today as standard restructured, from where I'm expecting close to, let's say, 1/4 of the book turning out to become NPA. So with all that, I'm looking at something like 1,600 crores of slippages happening from this entire portfolio. So if I grow my book to, let's say, close to double-digit growth in my coming year, in this year, I am expecting the overall percentage to remain the way they are.
Okay, sir. Thank you very much for joining in. That's the work coming in.